Welcome everybody. I am recording this as well. So we will be able to, for those of you who aren't able to join us live, hopefully you're able to watch this at another time. So I'm going to be talking with everyone about minimizing your taxable income in retirement. Tonight's going to be about 30, maybe 35 minutes long. So I'm not going to take up the whole hour like I scheduled. Just to get started a little bit more about myself, I am a financial advisor with Mutual of Omaha. I've been in the financial services industry for about 6 years now. I have a bachelor's degree from the University of Minnesota in economics, and I also have an MBA in finance from the University of St. Thomas, which is located here in the Twin Cities as well. All right, let's go ahead and get started and talk about how to lower your taxes. First off, this screen here, some disclosures for you. Obviously, we're going to be talking about taxes, but don't think that this is going to be tax or legal advice. You need to consult with your tax or legal professional for details and guidelines specific to your situation. All right. So I got to put that up there just so everyone knows and is clear with that. How does paying $0 in taxes during retirement sound to you? It's a great question. So although taxes can be complicated, understanding how common retirement plans are taxed can help you reduce the amount you owe in taxes and increase your spendable dollars in retirement. Here's our goals for today. Number one, we're going to try to better understand the tax rules we all live by. Number two, we'll identify some of the misconceptions about taxes and retirement. And then number three, help you reduce taxes in retirement using some of our, as a Mutual of Omaha's, tools and strategies. So let's talk taxes. All right, I'm going to, for the first half or so of this presentation, I'm going to be going over some basic terminology. So bear with me here, but I know everyone's going to be at different levels of tax knowledge. So these are some basic things that we do need to go over so that everyone can somewhat be on the same page moving forward here. So I'm sure, obviously, not many people enjoy talking about taxes, but that doesn't mean you have to dread the conversation or avoid it. Understanding more about the tax system, how it works, and getting ideas to help you maximize your income in retirement may even be a conversation that you actually want to have. I can help you with all this and make it relatively painless. Here are a few examples. So Social Security and long-term capital gains income taxes are two examples. And in those, just a few extra dollars can make you pay taxes when you otherwise wouldn't have had to. Some of the strategies I'm going to talk about may help you maximize your income in retirement to help you live a better life financially. Here we go, federal income marginal tax rate. Honestly, this is just the federal income tax rate that you pay on the last dollar you earn. We'll revisit this term a few times as we go throughout the night here. So let's take a look about the new income tax brackets. We still have 7 of them, and as you can see, 1, 2, 3, 4, 5, 6, 7. But the income tax percentages, the 10, 12, 22, 24, 32, 35, 37, those percentages and the income amounts have been, so the percentages have been reduced. These brackets here have been widened a bit, and this is for single filers for this year, 2020. This table is for married filing jointly, MFJ, as you'll see abbreviated throughout. So simply put, marginal tax rates apply different tax rates to different levels of income. As income rises, it is taxed at a higher rate. And you've probably heard this be called progressive taxing. So the first example, so for the first $19,750 that you make, you're paying 10% in federal income taxes. And then so on and so forth through there. I'm not going to explain that table. It's fairly straightforward. ordinary income. All right, obviously wages and salaries are taxed at ordinary income tax rates. But something you might not be aware of is that withdrawals from traditional IRAs and 401ks are taxed as ordinary income as well. Now, you're usually required to start taking required minimum distributions, or RMDs, from these accounts each year, beginning the year that you turn 70 and a half. Yep, 70 and a half. Now, additional types of income that fall under ordinary income tax rates are short-term capital gains, interest income from certain bonds and rental property, as well as non-qualified dividends. So first, let's talk about how different types of income are taxed. Then we'll take a closer look at how one source of income may impact the tax rate you pay on another source of income. As you can see here, income sources are on the left side, the way that they're taxed are on the right side, and it's different. Every single one is different. Your earned income tax, we just went over that. It's your marginal tax rate. Sale of real property or real estate, it depends. It could be a long-term capital gain or marginal tax rate. There's a long-term capital gains rate, short-term capital gains, like we just said, as your ordinary income, and then non-qualified annuities as your ordinary income as well. Here you got 401ks and IRA withdrawals. That's taxed just like regular income. And then you have something interesting here. Roth IRA and 401k distributions or withdrawals, tax-free. Same as life insurance distributions, tax-free. Obviously, a little asterisk here. You can see that distributions are taxable if they don't follow certain requirements. So Roth IRA contributions, or money that you put into them, may be taken out at any time, tax-free, penalty-free, no worries, no problems. But taking out the money, the portion of that money that's growing, that depends. If you're 59 and a half or older, and you've had that Roth IRA for 5 years or longer, withdrawals of that growth of those earnings, tax-free, penalty-free, no problem. But if you're under 59 and a half, it'll depend on the situation. Be sure to check with a qualified financial professional before making any big decisions on a Roth IRA withdrawal. Also, distributions from cash value life insurance policies must fall under certain circumstances to be tax-free. But it's fairly simple to be done, so don't be too nervous about that. One thing I didn't notice, or I didn't mention on here, was Social Security benefits. It's interesting. Up to 85% of your Social Security benefits can be taxed at a marginal tax rate. And that's going to be depending on your provisional income. And that's something we'll touch on a little bit later here. And then pensions, of course, those are just like earned income once you reach retirement. Long-term capital gains. So these are taxes on profits resulting from the sale of long-term assets like stocks and bonds, and also tangible things like land and cars and houses. Honestly, here's a trick of the trade. If you ever hear of long-term capital gains, think anything that you've held for more than a year. Safe to say that that's going to be a long-term capital gain or a long-term capital loss, but out of the scope of this conversation. This chart here is a chart of the ordinary income and the capital gains bracket together. So you have to add ordinary income and long-term capital gains together to figure out where you're taxed on the capital gains income you received. Notice how someone making $40,000 pays 0% on capital gains, and married, if you're married, filing jointly, and you're making $80,000, still paying 0% there. So this structure presents some really interesting opportunities for middle income taxpayers to recognize capital gains at a 0% rate when planning is done well. But as soon as you jump over that, as soon as you make 1 penny over $80,000, boom, 15% income tax. your effective marginal tax rate. A lot of times you'll hear it just be called an effective tax rate. So this is different than your marginal income tax bracket. Your effective rate can be much higher or it can be much lower. It just depends upon your underlying assets tax treatment and what impact it has on your other portfolio assets. To make it really plain and simple, just take the total taxes that you pay and divide it by your total income. There you go, plain and simple, effective tax rate. Standard deductions, here you go. So if you don't itemize, you can take the standard deduction. And this was increased by the Tax Cuts and Jobs Act of 2017. We'll talk a little bit more about deductions here too. So taxpayers, all of us, can either track itemized deductions such as mortgage interest, property taxes, charitable contributions, and complete a Schedule A when we file our tax returns. Or we can take the standard deduction. And what that is, so that's $12,400 for a single tax filer, or $24,800, so double for a married couple. For those of you who are filing as a head of household, it's going to be pretty much right here, smack dab in the middle between the two at about just shy of $19,000. And for those of you who are retired, sometimes itemizing isn't enough for you, where the standard deduction is really going to come into play for you. And also, once you reach age 65 here, or if you're blind, you get an additional deduction of $1,300 for each married taxpayer. Or if you're single, $1,650. It's a little bit different there. So if you choose to itemize, you can think of deductions as reductions of income for certain expenditures. You can track those items such as mortgage interest, investment interest, etc., and complete a Schedule A on your tax returns, like I just said. If you don't have enough of these allowable expenditures, take the standard deduction. On a side note, some retirees who have elective medical procedures they have to take care of might want to consider grouping them in a particular tax year in order to itemize. But for many retired taxpayers, like I said, there simply aren't enough deductions to warrant itemizing on a Schedule A. So the standard deduction becomes pretty important for them. Now here are some tax deductions you might lose once you enter retirement. Dependent children. Usually by the time you retire, your children are independent. Your mortgage interest, this only goes away if you actually own your home free and clear, no mortgages, no liens or anything on the property. Business deductions. So if you ran your own business and you're retired, business deductions are no longer applicable to you. Say goodbye. And then 401k and IRA contributions. In order to take those tax deductions, you have to have an earnings to make pre-tax contributions to employer-sponsored savings plans or an IRA. And if you're no longer working and earning an income, you're no longer going to be able to lower your taxable income by making pre-tax contributions. And now a tax credit. So we just talked about deductions. Those indirectly reduce your taxes. They reduce your overall income, so what you're paying taxes on. However, tax credits, they directly reduce your taxes by subtracting dollar for dollar from your final tax bill. So that's the beauty of the credits there. And there are two main types of tax credits. There are refundable credits and non-refundable tax credits. An example of that is the American Opportunity Tax Credit, which is also an educational credit for college expenses, and the Child Tax Credit. Those are refundable credits. So if you have children who are under age 17 at the end of the calendar year, you can get a tax credit of up to $2,000 per child on your tax return. And up to $1,400 of that is refundable. So a tax credit reduces your tax bill dollar for dollar. So 3 qualifying children, for example, can cut what you owe Uncle Sam by $6,000. And because this is refundable, if you only owed $5,000 in taxes, you would actually get $1,000 back because of the additional child tax credit is refundable. And on the other hand, we have non-refundable credits. So they kind of work the same, but they cut your bill down to 0. They only do that. So if the actual math ends up edging into the negative portion, you won't get the difference back. So using that same example as before, if you owed $5,000 in taxes and you had you had $6,000 in non-refundable tax credits, you now owe the IRS $0, but you're not going to get that $1,000 credit or refund because it's non-refundable. All right, and this is where it starts to get really interesting. So if you haven't been paying attention too much, now's the time to really start paying attention because this is where it gets fun. Provisional income. This is something that a lot of people don't really know about or understand. So many of you will be surprised and honestly dismayed to discover that a portion of your Social Security benefits could be taxable as ordinary income tax rates. Whether or not you're taxed depends on what's known as your provisional income. Like I said before, we'll see it here. So here, it used to be really simple. Social Security benefits used to be tax-free, period, end of story. But then, as part of the much needed, quote unquote, Save Social Security plan, as it's called, Congress decided to tax up to 80% of your benefit, with the extra revenue going to shore up Medicare. So in 2020, this year, you can receive Social Security benefits tax-free if your provisional income is less than $25,000 if you're single, or $32,000 if you're married. If your provisional income is more than that, you will be taxed on a portion of your Social Security benefits. Like I said before, up to 85% of your Social Security benefits can be taxable. And these numbers here are not very high for retirees. To make it very simple here, this is how the IRS calculates your provisional income. They take your adjusted gross income, they add non-taxable interest, and they add half of your Social Security benefits. And if any of that equals the, what was it, the 25,000 or 32,000 or more, then you could be paying taxes on your Social Security benefits. Not a fun thing. Here we have a list of what is counted as provisional income assets. It's big. About a dozen or so items there in those 2 columns. And then, like I said before, not provisional income assets, Roth Iras, Roth 401k, life insurance. I'm looking at my notes here. So there are rules that must be followed in order for life insurance or Roth assets to not count as income and be included in your provisional income, as I stated before. Can one income source impact the taxation of another income source? The short answer to this question is yes, and we're going to talk about how. So the snowball effect. Combining Social Security benefits with ordinary income, such as IRA or 401k withdrawals, or even tax-free interest income, can sometimes create what's called a snowball effect. This results, so a snowball effect in which the resulting tax on one additional dollar of income can be far greater than what was actually expected. So one extra dollar of additional taxable income can sometimes put you into a higher bracket and or cause higher taxation of Social Security, long-term capital gains, and ordinary income, which are all taxed under the tiered rates we saw earlier in the presentation. So here's some additional considerations. Medicare excess premiums usually only impact higher income people, but if you're considering converting a traditional IRA to a Roth IRA, this could impact you in the year you do a Roth conversion or make a large, unusual purchase. Medicare is now means tested, and these thresholds that you see on this table include the full Social Security benefit, unlike provisional income, which looks at only half of your Social Security benefit. Now, if you fall over the threshold, you'll end up paying an extra Medicare Part B or Part D premium. In the scope of the whole total tax bill, it's probably not that big of a deal, but you will feel it still. So it's not entirely insignificant. Then surprise, surprise, there is such thing as a 3.8% net investment income tax. This usually also impacts higher income taxpayers, and it creates an additional 3.8% tax on net investment income, which includes capital gains and dividends, interest in non-qualified annuity payments, passive business income, and rents. So basically, if it's not derived from work or your own capital, and it falls over $200,000 if you're single, or $250,000 if you're married, it's likely subject to the 3.8% additional tax. So just add that on up to your tax bill. All right, we're going to talk about a case study, about a quick example here, really put some things together for you and help you understand how this really can come together and what the difference might be in taxes in retirement. So we have John and Jane here. They're married, filing jointly. They're both 50 years old. Now they plan to retire at age 67, so 17 years from now. And they currently make $150,000. They want to continue their lifestyle in retirement. They currently plan to have $50,000 of combined Social Security income per year, and $50,000 of long-term capital gains, and $50,000 from IRA withdrawals. So scenario one, assuming that 17 years from now, they're 67, once they enter retirement, we would use the standard deduction of a married couple, which in this case turns out to be $27,400. And if you're thinking that doesn't match up with the number you said earlier, Jacob, that's because they're older than 65 and they get $2,600 additional to that. So they with this, we find that they are projected to pay about $12,682 in federal income taxes. Note, this is only federal. I'm not including state taxes here. So it's either this or it could be higher. Some states, obviously, you don't have to pay income taxes. So how could we improve this outcome? They're obviously paying about 8.45%. This is their effective marginal tax rate. So if we can improve this, there's a couple of ways. Remember, Roth IRAs or cash value life insurance. And you're probably thinking, wait, what about a Roth conversion? In this case, it wouldn't help them reduce their taxation this year, but rather increase it. But you could consider a Roth IRA conversion for the potential tax savings in future years when you may need tax-advantaged retirement income. So you can convert traditional IRA assets in years where your income might be a little lower and fill up your tax bracket up close to the top of switching over to the next one to position yourself for future years. So what if we could plan now in order to keep more of that $12,862 of taxes and use it for their expenses in retirement rather than paying taxes? So instead of having $50,000 of ordinary income in retirement, what if those dollars were in a tax-advantaged income asset without the negative tax impact a Roth conversion would have on current income taxes? So if you see where I'm going with this, it's mostly leaning on Obviously, you can see here, if it had a bucket, so if John and Jane had a bucket of tax advantage income in a cash value life insurance policy or Roth IRA instead of ordinary income, what would happen? So here we have scenario 2. If they had funded an asset that provides a tax-free bucket of income instead of a taxable bucket of income for their retirement, John and Jane could have saved most of those dollars from taxation and used them instead for paying their retirement income. So we were at almost 8.5% effective tax rate. They're at 0.5. It's a 8% difference there. That's huge. Keep in mind though, if they make changes to this plan, for example, during the years they are funding the tax-free bucket instead of a taxable bucket, the dollars they use to fund the taxable bucket will be with after-tax dollars and not pre-tax dollars, which means they're taking home less money in their working years than they otherwise would. Here you can see a comparison side by side. Using today's current tax laws, you can see the substantial tax savings from having a tax-free bucket of money. John and Jane's total tax is reduced in the second scenario by using a tax-free bucket of income. Let's see, it all started up here with their adjusted gross income, their AGI. Using a taxable bucket of income in retirement will cause John and Jane to have more provisional income and thus more of their Social Security income taxable as income. It will also cause more of their long-term capital gains to be taxable in the 15% bracket like we saw earlier. They can save most of those dollars from taxation and use them instead for their retirement income if they have a tax-advantaged bucket of money. So a review here. So by creating a tax-free bucket of income, it helped reduce their tax rate from 8.5% to 0.5%. This hypothetically saves them just over $12,000 in taxes every year during retirement. So they're saving about $1,000 a month doing that. What can you do with $1,000 a month? That's pretty big. It also provides them with additional net income each year in retirement to use for their needs, not taxes. And then less spendable income and taxes during the years you're funding the tax-free bucket of income. Like I said, in their working years, they were taking home a little less money each month in order to not have to pay taxes later on. So they're paying taxes now, not having to pay taxes later on. So remember when we spoke earlier about Roth IRAs and cash value insurance, both of those products allow for a tax-free income stream in retirement. But keep in mind that certain requirements must be met in order to keep the distribution tax-free. So what assets can help? These 3 things that we talked about earlier. Now, some of you might be familiar with these products. Some of you might not. Let me take a moment and describe them a little bit further for you. The cash value life insurance is a contract between a policy owner and the insurance company. In most cases, it provides a federal income tax-free death benefit to be paid to a designated beneficiary or beneficiaries at the insured's death, but also provides for the tax-deferred accumulation of cash value during the insured's life. That's a little loaded there, but in layman's terms there, you'll be accruing value in this cash value life insurance policy that you can later on use. Now, in most cases, loans and withdrawals from a cash value life insurance policy are received income tax-free. This assumes that withdrawals do not exceed the amount of premiums that you've paid, less any other withdrawals, and the policy is not what's called a modified endowment contract or a MEC. And that it goes into really big details in the IRS tax code, which I'm not going to get into. Roth IRAs and 401ks. So these are retirement accounts that allow a person to set aside after-tax income, letting it grow tax-deferred and having the ability in retirement to take it out tax-free. So you're putting in money now, you've already paid taxes on that money. You're putting in money in a savings account, a Roth IRA, an individual retirement account. So you're putting in money that you've already paid taxes on, and as long as the IRA has been open for at least 5 years and you're 59 and a half or older, all the withdrawals are free, tax-free. You are not required to take what's called RMDs, required minimum distributions from your Roth, and contributions can be accessed at any time. So like the Roth IRA, a Roth 401k allows you to withdraw contributions and earnings, tax and penalty free if you're 59 and a half and or older, and you've met that 5-year rule. However, here's the catch. If the rollover is to a Roth IRA, so you rolled over the Roth 401k to a Roth IRA, that holding period starts over. So some options for funding this kind of idea. Here you go. So selecting the Roth feature in your 401k plan or contributing to a Roth IRA. For those of you who have a 401k, look at it. You probably have the ability to change that to a Roth 401k. You can convert traditional IRA to a Roth IRA. Little asterisk here. The conversion of a traditional IRA to a Roth IRA will cause an increase in your taxable income for the year of the conversion itself. If there isn't a Roth feature in your qualified plan, consider using current contributions over and above the employer match to fund cash value life insurance instead of funding the 401k. So just contribute into your 401k up to where your employer matches you. Anything extra, look into a cash value life insurance policy. If you currently earn over the Roth IRA income limit, consider using those intended contributions, what you would have put in, to a cash value life insurance policy as well. Yes, if you make too much, you cannot have a Roth IRA. There are income limits to that, which I haven't gone over, but we can talk about that at another time too. And if you would like to fund a Roth IRA, but want to put it in, but want to put in more than the contribution limits, which are only $6,000. If you're over 50, it's $7,000 then. Consider putting the extra savings into a cash value life insurance plan. So fortunately, as we age, we tend to be at a higher earning capacity. And many have fewer, and we may have fewer expenses, making this a great time to identify and use quote unquote found money in your budget for retirement goals. Bonuses and raises can free up dollars in a budget to afford these products as well. And then a little bit on cash value life insurance here. So one way to avoid larger tax hits is by using a cash value life insurance policy. It will provide your loved ones with a death benefit in the early years, and its cash value may also be used as a source of supplemental retirement income. That can help you avoid increases to your effective tax rate, since a loan from what's called an indexed universal life policy or cash value life insurance policy is generally not counted as taxable income. And some other items to consider while doing this. Your policy may lapse if your premiums aren't paid. Most life insurance policies require health underwriting, and in some cases, financial underwriting. Guarantees are backed solely by the financial strength and claims paying ability of the issuer, of the company that it's through. Policy withdrawals are not subject to taxation up to the amount paid into the policy. Policy loans and or withdrawals will be taxable to the extent of gain if the policy is a MEC. And then policy loans and or withdrawals also reduce the cash surrender value and policy death benefit and increase the chance that a policy will lapse. Taking a policy loan could have adverse tax consequences. So there are things to consider in this, and these are things that if you would like to, you and I can talk about them on a individual basis as well, because it's going to be different for everybody. So let's go back to our example of John and Jane. So just real quick, here's an illustration of what would have happened if Jane decided to purchase a cash value life insurance policy. So this policy had $375,000 as a death benefit. That's what this 375 is up here. And then you're going to see an accumulation phase and a disbursement phase. So in the accumulation phase, from age 50 to 66, so 16 years there. So she's paying $18,000 a year into the policy. So that's the premium. Every year she's putting in $18,000. So over the course of 16 years, she's put in $288,000. Her benefit, her death benefit also increased a lot throughout that time. Now the disbursement phase, when she retired at age 67, so for 15 years now, from 67 to 81, 15 years, she's able to take out $50,000 per year for a total of $750,000. So she's able to put in, she's able to take out more than 2.5 times the amount she put into the policy, tax-free, mind you. So that is a powerful, powerful tool. So there are a lot of ways to control taxes and plan in advance to create tax-efficient retirement. You got here, diversify among your account types. You have a qualified 401k or IRA. Get that match. Get that free money from your employer. You have Roth conversions, Roth 401k, or life insurance, or non-taxable or non-qualified stuff. So these are all good things to have. You want to be able to diversify all these accounts that you have. And then use tax-deferred products where appropriate, properly blend distributions from different accounts. Consider which assets should be held in which account type. So diversification is obviously a financial advisor's favorite phrase, just diversify. With that, everybody, I'm sure everyone's going to have some questions. In respect of your time, however, I'm not going to answer any questions tonight, but I will leave this screen up for a few moments with my contact information. I'd be more than happy to visit with each of you, either over the phone or via Zoom, and talk about your specific situation. So please take note, email me, call me, and let's talk. Let's see if we can set up a meeting and talk about your specific situation and how I might be able to help you. If you would like help determining how taxation may impact your current retirement assets, or even how diversifying those assets might benefit you, I can help. Thanks for coming, everybody. Hopefully you enjoyed it.